Most retail investors are playing AI the wrong way. They're just glued to the biggest names like Nvidia, Palantir, and Tesla, while some of the future AI winners are still flying under the radar. Recently, 4 lesser-known AI stocks posted results that should have dominated the headlines. Massive earnings beats, strong guidance, serious momentum. But while the market focused on the giants, these companies quietly moved into a completely different growth trajectory. One just crushed earnings and said AI data center optics are becoming a major growth driver. Another has now delivered 17 straight quarterly earnings beats. That's more than 3 years without a miss. And the final stock, it's already up over 275% in the past year, yet analysts in our quant ratings model suggest there could be plenty more upside ahead. By the way, I'm Steve Reitmeister, but my friends call me Righty. I spent nearly 20 years the editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com, where our quant team runs 4,600 stocks through 115 different factors every single day to find the names most likely to outperform. If you're getting value from this kind of breakdown, then please hit that like button. That tells the algorithm to send you more videos like this instead of the usual noise and nonsense. A quick disclaimer before we dig in, investing carries risk. And as you know, past performance doesn't guarantee future results. Always do your own due diligence before putting real money to work. Let's kick it off with stock number 1 in ADTRAN with a symbol of ADTN. This is a fiber networking company that doesn't get a lot of media coverage. That obscurity is part of what makes it very interesting right now. ADTRAN builds the optical networking equipment that moves data inside and between data centers. Every hyperscaler building out an AI campus needs this layer of infrastructure. Here's another reason why the stock has become interesting now. In early May, they reported first quarter 2026 earnings that beat estimates by a whopping 56%. This proves there is a fundamental shift taking place in their business model. Their earnings call also highlighted a product called Lightwave 800. This is a next-generation optical module purpose-built for AI traffic inside data centers, designed to handle the bandwidth and power constraints of modern GPU clusters. Now, management is clearly positioning ADTRAN as a direct beneficiary of the AI data center build-out, and the Q1 numbers suggest the strategy is already starting to pay off. Wall Street has already taken notice. 3 analysts now cover ADTRAN with a consensus strong buy recommendation. Mike Genovese at Rosenblatt is the most bullish of this panel. He's ranked the top 1% of all analysts based upon his stock picking performance. Not only does he label ADTRAN as a strong buy, but he also has the highest price target, suggesting over 33% upside potential in the year ahead. No doubt even higher if they keep pounding out impressive earnings beats like this past quarter. ADTRAN also scores in the top 4% of all 4,600 stocks we analyzed in the Zen Ratings quant model. That leads to an elite A grade, which implies strong buy. Beyond this overall A rating, ADTRAN also scores highly across our 7 different component grades. For example, it ranks in the top 16% for momentum, top 11% for growth, and top 6% for sentiment. That's a good mix that lightly points to more upside ahead. That's because it suggests the smart money accumulation, solid growth prospects, and a strong positive trend already in place. One note of caution, ADTRAN carries meaningful debt on its balance sheet, and since they're banking on AI, any slowdown in carrier CapEx spending could put pressure on this stock. That said, a small-cap fiber networking company with a strategic push into AI data center optics, recent monster beat in hand, Wall Street support, and an impressive Zen Ratings review, that is an attractive setup that doesn't come along often. All right, before we move on to the second stock on the list, a quick ask for you. If you find breakdowns like this useful, then please hit subscribe and turn on the notification bell. We publish data-driven analysis like this all the time, and this is the best way to make sure you get to see it next time. Now on to stock number 2 in Digi International with a symbol of DGII. Most investors think AI is squared away entirely in the data center, but the next leg is moving to the edge. We are talking about industrial machines, vehicles, medical devices, remote energy infrastructure. All these things stand to benefit so much from AI, need AI inference happening locally. And that means at the edge, not just in the data center. And all of it needs to connect back to the networks. That connectivity layer is what Digi builds. Digi makes the Internet of Things modules and cellular gateways that link edge devices to the cloud. Without companies like this, the next wave of AI products simply can't function in the field. Here's the recent catalyst in early May. They reported earnings that included record recurring revenue, record overall revenue, and record cash flow. That's 3 impressive operational records in a single quarter. All in all, revenue grew 25% year over year, which is an impressive feat. The growth came from a mix of strong organic momentum and contributions from 2 recent acquisitions, Particle and Jolt. Best of all, management raised full-year guidance, proving that this was not just a one-quarter phenomenon. Here's a number worth pausing on. Digi has now beaten Wall Street estimates 17 quarters in a row. That's over 4 years without a single miss going back to early 2022. When a company puts together that kind of consistency, it can suggest the underlying business is just durably better than the street understands. This proves out in the Zen Ratings analysis of Digi across 115 different fundamental factors. The company scores in the top 3% of stocks earning another coveted A rating. This includes 4 standout component grades with top 16% for sentiment, top 15% for safety, growth even better at the top 12%, and finally top 8% showing for momentum. This is a well-rounded and attractive investment profile. Time to talk about the risk. Forward revenue growth is projected below the broader industry average, which means this thesis leans on margin expansion and earnings leverage rather than top-line acceleration. However, all in all, we are talking about a company with stellar execution as proven out by their 17-quarter beat streak. This also shows up in their top-notch Zen ratings, and finally, they are well positioned for the next leg of AI growth as we move to the edge. Perhaps it can edge into your portfolio as well. But the next pick takes that earnings consistency story yet to another level. I'll explain more in a minute as we talk about the case for stock number 3, RingCentral, with a symbol of RNG. This company builds the cloud communications platform that runs voice, video, messaging, and contact center operations for thousands of businesses. The traditional fear with this kind of company was that AI would make voice and messaging platforms obsolete. The reality has proven out to be quite the opposite. RingCentral spent the last 2 years embedding AI agents directly into its platform, and that strategy is now showing up in their financials. The CEO calls this an AI-first customer engagement platform at scale, and the numbers back up that framing. In early May, RingCentral reported Q1 2026 earnings growth of 20% that handily topped Wall Street estimates. Results were so good that the company also declared its first ever quarterly dividend. That shows their confidence in more growth ahead. And the consistency underneath is exceptional. Ring has now beaten Wall Street earnings estimates 20 quarters in a row. That's 5 full years with a single miss going back to mid-2021. But perhaps the most important business signal is on the AI side, which lends further credence to the thesis and what the CEO is saying. That's because annual recurring revenue from customers using paid AI products doubled year over year. That's the first hard evidence that AI products are a real revenue contributor. Management is clearly feeling very positive about the development, leading to a raise for the full year 2026 guidance on revenue, margins, and free cash flow. Not only is growth looking up, but valuation is another attractive feature of this stock, as RingCentral trades at a forward PE of 9.39, ridiculously low, and a PEG of just 0.71. Both numbers signal a stock price for slow growth, but not necessarily for a business that's actively accelerating thanks to AI. This type of mispricing tends to close over time, rewarding the early investors. Now, not surprisingly, RingCentral scores in the top 2% of all stocks tracked in our system. That's a Zen rating of A, firmly in the strong buy category. As expected, it has a standout grade for value in the top 5% of all stocks, given what we just said about the forward PE and PEG ratio. That is not the only strong component grades. It is also top 5% for growth and financial strength. These are the best indicators of stocks likely to beat earnings in the future. Then tack on a top 15% showing for safety. Growth, value, and safety rarely come together, which makes the stock all the more appealing. Now for the potential downsides. Revenue growth has decelerated from over 30% a year, going back a few years ago, to about 5% today. The bull case depends on AI annual recurring revenue continue to scale, allowing profit margins to expand. But there's more than enough to be optimistic about here. A 20-quarter earnings beat streak, the first dividend in company history, the doubling of AI recurring revenue, and the slew of A grades across the Zen ratings. Perhaps it's time to dial up these shares into your portfolio. And by the way, before I get to the closing pick, a quick note. This is exactly the kind of analysis I walk through live every Monday at 7 p.m. Eastern Time. Not just what I'm buying, but how I'm finding it so you can do the same. I also share my hand-picked stock of the week, blending the power found in the Zen Ratings model along with my greater than 40 years of investing experience. All this and more is part of our live training session this coming Monday at 7 p.m. Eastern Time. It's totally free. Just sign up at wallstreet.com/live. You'll also find a link in the description or just scan the QR code you see on your screen. Let's close with a stock that had seriously impressive price action recently, and signs point to even more good times ahead. That final stock is Silicon Motion with the symbol of SIMO. The company designs the controller chips that sit inside the world's solid-state drives, also known as SSD. The SSD in your computer, every data center flash array, and basically every consumer drive that handles fast storage, they all need Silicon Motion's products. They count 7 of the world's top 10 NAND makers as customers. Here's why this matters for AI. Training modern AI models requires moving enormous data sets at speeds the storage layer has historically struggled to support. As AI workloads scale exponentially, demand for high-performance SSD controllers scales right alongside. Silicon Motion sits at that exact intersection. Here's why this caught my eye. In late April, Silicon Motion reported Q1 2026 earnings, and the numbers were truly extraordinary. We're talking about revenue that more than doubled year over year, leading to a 161% increase in earnings. This far surpassed Wall Street estimates, propelling shares higher. Now, I want to be crystal clear about one thing. This isn't some sort of undiscovered gem. The market has been paying attention. That shows up loud and clear in the recent price action that shares are up roughly 275% in the past year alone. Gladly, it appears that the good times are not over. That's because we're dealing with a company turning the corner on a multi-year NAND cycle and accelerating into the AI storage tailwind at exactly the same time. And this growth story likely has much more legs to run. This is supported by the forward-looking growth story. Currently, Wall Street analysts predict that Silicon Motion will enjoy earnings growth north of 60% a year going forward. This blows away the broader semiconductor industry. That exceptional growth leads these analysts to give the company 3 strong buy and 2 buy recommendations. Very rare to see no holds or sell ratings on a stock of this nature. This is strong evidence that they expect more upside ahead. Now, the Zen rating is on the same page, given that the full scan of 115 factors places the company in the top 3% of all stocks analyzed. This generally points to strong odds of more outperformance ahead. The standout component grade is sentiment, which lands in the top 2% of stocks we track. This ultra-high rating says that the smart money crowd are still enthusiastic about the stock. Not just Wall Street analysts, but also a measure of positive institutional money flows and insider buying. The strong component grades don't stop there. We're talking about top 26% for value, top 21% for safety, top 9% for growth, and not surprisingly, top 8% for momentum. The synthesis is clear. Strong momentum, top-tier institutional sentiment, and a business riding a real AI storage tailwind. That combination tends to keep moving higher once it gets started. The main risk here is that the NAND storage pricing is historically very cyclical. Thus, any meaningful slowdown in AI CapEx spending would likely push down expectations and the share price as well. But I still think the positives far outweigh the negatives here, such as the red-hot earnings growth around 60% a year as we move forward. Overall stellar Zen ratings profile, the still strong smart money support in the top 2% of all stocks, and you add it up, and this has the makings of a stellar buy high, sell higher selection. Now I want to hear from you. Which of these 4 picks do you think has the most upside potential? Or are there any other overlooked AI stocks that I didn't mention here that you think I should? Sound off in the comment section below, as I always enjoy hearing what you have to say. There's another high-tech area full of overlooked stocks that might interest you. I recently did a video on my top 3 robotics tickers. Better yet, they're all trading under $15 a share. That's the video popping up on your screen right now. Go give it a watch if you like what you've seen here today.